Good evening, everybody. Thank you very much for joining in. This side Rahul Magan here. I'm speaking as a Chief Executive Officer of a Treasury Consulting LLP, and at the same time, I'm also acting as a Country Director for two international forensic firms, which is Association of Certified Forensics Accounting Professional and Association of Certified Forensics Investigation Professional Inc. The former one, which you see on the YouTube video, it's a New York headquartered, and the later one, which is ACFAP, is a Dubai headquarter. You are very pleased to see the logo of our website as well, logo of Treasury Consulting LLP as well, which is right here, which is in yellow mark, right? In blue mark. And today we are going to speak about very interesting topic. As I earlier suggested that now our YouTube channel would be have a presentation type videos as well. So today we are going to speak about very interesting topic, and one of the topics is your Indian corporate bond market. Now in this is a 4 slider presentation, but there are a lot of things which I am going to cover in this presentation, wherein I would let you know that how the things would happen in India, what are the things which are changing in the Indian corporate bond market. Now if we carefully see, what do you mean by bond market? Bond market is nothing but which is an integral part of the fixed income market. Now fixed income market do not have any unique definition because it is vary from country to country. If you talk about US, Australia, Tokyo, your Singapore, your Russia, your China, and all things, their definition of the fixed income markets vary from country to country. But when it comes to India, the fixed income market is very small. That we need to appreciate, and that we need to agree also, that fixed income market is very small. And one part of the fixed income market is your corporate bond market. In fact, it is not corporate bond market, it is bond market. Now you can say that precisely that bond market is divided into two parts. One is corporate bond market and one is government debt market. We cannot have any presentation on the government debt market because you all very well understand that the government debt market is nothing but a market wherein the government issues a debt, and in India the government debt market is very limited in nature, extremely limited in nature. But nonetheless, that is something which we are not here to discuss. Let's move on. So these are the 5 or 6 important points that we are having today when it comes to the Indian corporate bond market. Number one, in the past decade, Indian corporate bond market has grown at a CAGR. CAGR stands for compounded annual growth rate of 20%, and sitting today it's standing at roughly 4.8 trillion INR. So what I meant to say that you are in 2016. If we go up in the past decade, right, the Indian corporate bond market has grown at the rate of 20%, and sitting today it stands roughly 4.8 trillion INR. Now 4.8 trillion INR stands at 48,000 crores, which is of course very small, which is very small. Secondly, if we look at the fixed income market, then we'll get to know that the bond market is growing much faster. Sorry, the commercial paper is growing much faster than the fixed income market. Now commercial paper is going very faster, and in terms of the outstanding credit in a corporate bond market, commercial paper accounts for the 5th. You might have heard about a word which is masala, which is masala bonds. Masala bonds is nothing but an option which is given up by the Indian Reserve Bank or the Central Bank of India to the corporates in India, that if they wanted to raise dollars outside India, then they can use it via separate way. And what is the separate way? They are going to issue a INR denominated bond at a coupon rate of say 7.5 to 7.8%, depend upon your QSD. QSD stands at quality spread differential. So they are going to have a corporate bond. They are going to launch the INR denominated bond to a foreign player, and that foreign player will buy this bond, and he will take a currency risk. That is an unfortunate fact that if you look at this, which is hedging of a masala bond, is just like a carry trade, whereby you will first convert your dollar assets into INR, and then you would be converting back INR into dollars. So what's happened is, this is one part of the corporate bond market currently. So suppose you are TCS, Tata Consulting Services. You are setting up your center in Bangalore, and in Bangalore there is a requirement of 50,000 crores. Now there are two options. If you raise this money in India, then you would get 7.52, you will get roughly 8.5% of interest, which is exorbitantly high. and considering the economic environment or the return and government and everything, that this is not very viable. So what you did, that you decided to issue this bond at the rate of 6.5 to 7% to people sitting offshore, and offshore market stands at NDF, non-deliverable forward, non-deliverable market. Now please note very carefully that once you decided to issue INR denominated bond outside India, then the hedging can only be possible only in the offshore part, unless the person who is investing in India or who is sitting in offshore and investing in the masala bond basically will treat this like a carry trade. That is something very technical, and that we are going to have an additional video that how to hedge the masala bonds. But nonetheless, SEBI has also mandated that now the book building would happen via or there would be book building. Book building, you understand that book building is nothing but when an iBanker will decide the price of a share. So they are going to give some base price, then people start bidding at the highest price. They are going to have a book building. Now book building is of two types. Once you have a Dutch auction and once you have a French auction. So these are the 4 or 5 important points which is happening in the Indian corporate bond market. But unfortunately, these all looks very rosy, that people starting with the masala bond. But the reality is that if today you will invest in a masala bond and once you hedge your masala bond sitting at offshore also. When I'm using offshore, there are a variety of locations you can hedge, which is Singapore, Malaysia, New York, Thailand, Dubai, Philippines and all. And the cost of 1 year offshore is approximately 6% to 7%. Take it flat, 6.5%, which is sitting today, which is 4th of August 2016. Even then, the net return which you are getting is less than 2% or 2.3%. So ultimately, masala bond is having one issue, which is a hedging issue. So masala bonds, it's just like a very fancy word, but may or might not hold true. And besides that, there are various other problems with the Indian corporate bond market. They are as follows. Number 1, Indian corporate milieu is becoming conducive in multiple ways. Stable macros, especially durable inflation gains are crucial here. And India is getting there, though the flexible inflation targeting and the monetary policy framework. That is a separate fact that Raghuram Rajan will not be a part of this because his term will get over. Now the foreign investor who see the currency stability and good yields in the time of the negative yields, they would surely come to India. Because if we see carefully today, more than $20 trillion of our sovereign debt is having NIRP. NIRP stands for negative interest rate. And India is offering approximately 7.5 to 7.8, which is very positive in nature. But we should not forget that there are many countries who are offering that. Unfortunately, Australia is losing because Australia has reduced their overnight rate from basically 2.5% to 1.5%, which is 100 basis point decrease. But nonetheless, let us see how the things would move. Secondly, CRISIL estimate that Indian infrastructure would need at least 43 trillion INR. 43 trillion stands at 43,000 crores for till next 5 years, which is 2020. And according to their estimate, approximately 1/4, which is 5 trillion, which is 1/4, which is close to 10 trillion, which would come from corporate bond market. Next, third, which you can see that public sector banks are facing the biggest issue right now. Sitting today, which is as per the books closing, which is March 2016. Indian public sector banks are having non-performing assets of 5.82 trillion INR, which is very, 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 very high. If you compare with any country, then this 5.82 trillion is exorbitantly high. And if this would continue, you very well understand what would be the scene. Number 4, there are some regulators, Reserve Bank of India, SEBI, FMC and others. They would like to sync their regulation with Basel III, and that too with the liquidity framework. And if this would happen, then this would also ease the ways for the banks as well as the foreign player to come and invest in India, invest in corporate bond market. But at the same time, such investment may or might not be sure in nature, in the sense that it requires some time. So if today Reserve Bank will think to sync their norms with Basel 3, that doesn't mean that they are going to do it tomorrow. They need some time, and that time matters. Number fifth, the ongoing innovation in securitization, new vehicles like REIT, real estate investment trust, and hybrids for insurance sector would attract more issuers. Last but not the least, the bankruptcy code which India has passed. Although this has currently been passed and on paper, not a single case has been fought supporting this bankruptcy code. So we don't know how practical it is, but only time will tell how practical it is. Now, based upon this bankruptcy code, India position when it comes to doing business will surely improve, and with this we would have very good background for the corporates to issue their bond market. On the other hand, there are a lot of issues also which Indian corporate market needs to face. Number one, we need to reduce the concentration risk in banking. Large corporates need to be persuaded to raise a portion of their funding through corporate bonds and commercial paper. The RBI move to make it costlier for the banks to lend to a specific borrowers round is encouraging. It is imperative that institutional and the market frameworks are strengthened. We need a national bond guarantee fund for a credit enhancement, but this is something not possible. The yield is also an issue. Today there is a limit when insurers can invest in a insurance infrastructure special purpose vehicle based upon their net worth, which reduces their appetite. And as we understand that India needs 43 trillion INR in the next 5 years, which is till 2020, to make infrastructure better. So overall, you understand that corporate bond market is must. We need to go through corporate bond market, but at the same time we clearly need to understand that it is not an easy job. If we go here, we also need to understand that we cannot be focused on only one instrument, which is commercial paper, which you can see here. Although you are saying that you are very well saying that you are coming up with a masala bond, which is very good. I'm not saying this is bad, which is very good. But at the same time you need to understand that the hedging cost of the masala bond should not be too high that a person cannot invest in that. Next, SEBI said that there should be e-book building versus a physical book building in the past. However, at the same time we need to understand that if you go for e-book building, then cyber threat is looming on everything. Today the biggest threat for every corporate is the cyber threat. And if say today L&T will, like, take an example of L&T Infotech, who came up with an IPO. Suppose it was a e-book building, then you need an expert who can prevent this book building from any kind of cyber attack. That is also a cost because the physical infrastructure is not maintained as per that. So of course, Indian corporate bond market is growing. There are a lot of green shoots which are coming up, positivity is coming up, but at the same time long way to go. The way is not easy, and as we clearly understand that sitting today 2016, US is having the largest bond market across the globe, followed by Tokyo and followed by China. So if we are seriously interested to follow China, then we need to work very hard. We need to look everything minutely, and we need to understand that everything which we are doing is having a pros and cons, so we need to be carefully as per that. I hope you understood this video. You understood what do you mean by corporate bond market. You understood that what exactly are the issues in the corporate bond market and so on and so forth. You're always welcome to join our brand, which is Foreign Exchange Maverick Thinkers, on LinkedIn. We have our LinkedIn FX Club. We have our YouTube channel. You have Daily Motion. We have the derivative groups on WhatsApp. We have Basel 3 groups on Telegram. We have Foreign Exchange Academies of Skype, Facebook. We have Google groups, Google Blog, and we have Digital Library on Google. When it comes to email, you're welcome to contact us at treasuryconsultingllp@gmail.com. My alternate email ID is rahulmagan8@gmail.com. My contact number is 9899242978, and my Skype contact is rahul5327. Before winding up the video, I would like to stress just simple fact that yes, Indian corporate bond market is growing. The green shoots are visible, but you should not be overconfident in nature. Overconfident in the sense that you will simply going to invest without understanding the pros and cons of the Indian corporate bond market. If this is the case, then you are bound to lose. So be careful. If you need any kind of technical guidance, you can contact us. Thank you, and I hope you learned well. Thank you and have a great day.